What's up, guys? My name is Jack, and welcome to Invest Today. Today, it's 11/6/2018. That's midterm day. Go out and vote. Do your civic duty, guys. And let's jump in into the stock that we're going to talk about today, which is Google. And Google, we're going to specifically talk about why I have such a big position. It's my biggest position. It's in my tax-deferred IRA account. That's a Roth IRA. If you want to learn more about those and compare and contrast traditional and Roth, I have a video on that on my channel. So today we're going to talk about specifically Waymo and then some chart analysis a little bit later. The Google valuations are historically low right now, and that's in regard to PE ratio compared to companies of relative size. Waymo has the potential to change the transportation industry. Again, that's their autonomous driving car little project they have going on. And any buy under the 200-day moving average right now currently does not factor Waymo into the Google valuation at all. So you're pretty much getting Waymo for free, guys. When compared to companies of relative size, Google, it's the cheapest on a valuation perspective. Amazon trades at 127 PE. These are all trailing 12 months. Netflix is 111 PE, and Microsoft is a 50 PE. So if you take a look at Google, it's around a 45, 44 PE ratio, and that's all, again, trailing 12 months. When considering the revenue streams and diversification of Google's business models, the companies above, they don't stack up on a valuation perspective, guys. Google has recently, and when I say recently, I mean in the past 5 years, been attempting to diversify away from their main revenue stream, which is advertisements. Everyone knows that, and explore other possible giant industries. Amazon, Facebook, and many other people have attempted to explore the lucrative online ad space, and they've been really capitalizing on it. And it's impossible to not see the potential of Amazon AWS. Or Amazon Web Services. The online ad space is truly becoming a very crowded industry, and Google's looking to diversify away from that. So Waymo, it's still in the beginning stages and has yet to produce any revenue, only massive expenses. However, it's easy to see the possibility of having a revenue stream through the installation of Waymo technology on all or at least most cars. Currently announced, Google has partnered with Jaguar. And according to the website, they state that we'll start testing these vehicles this year, and we're at up to 20,000 I-Paces to Waymo's fleet in the next few years. That's enough to drive about 1 million miles in a typical day. However, competition to be the leader in autonomous space, it's fierce, to be honest. And with virtually every major car manufacturer stepping in, Google needs to really separate itself. According to Business Insider, they state the company is also building all of its hardware in-house, allowing it to slash the price of its LiDAR system by 90%. And this is according to Waymo. LiDAR is notoriously expensive, and it's a high-end system that can cost as much as $75,000 a pop. Waymo has also announced a partnership with Lyft, Avis, and Intel. By having all the hardware made in-house, they're able to undercut the price per unit relative to the competition. When I say competition, I mean companies like Ford and GM and all those other car companies that are looking to get into this space by making the autonomous technology, like the LiDAR system, and the actual car. Google's different. They're only focusing on the LiDAR system and having that installed via partnerships with automakers and like Lyft, companies of that sort. So this could be really the decided edge. As a system costing $75,000 to purchase on the manufacturing side, which means they're going to sell it at a vastly higher price, on the back end to the consumer. That would price the vast majority of the population completely out of the equation. As of right now, could more than likely become cheaper later on. Furthermore, through strategic partnerships with companies, most notably Lyft, Google is uniquely positioned to capitalize on the industry, juxtaposed to the slower moving automakers such as Ford. By operating simply on the hardware aspects of the market compared to the actual manufacturing of an automobile, this allows Google to focus on just mastering the smaller aspect of a broader design. This would, allow them to better master the technological aspect of autonomous driving and lead to lucrative partnerships down the line. Let's take a look at the stock chart and employ some technical analysis to find a good entry point for us to buy into the stock. It is very clear to see that Google is below the 200-day moving average, which is the red line on your screen, and has found some support around the $1,050 mark. And if you look at its 52-week high, it has sold off in a big way as of late. However, it has found some resistance below the 20-day moving average, which is the blue line on the screen. The volume has been heavier than usual, as you can see in the yellow bar graph below the actual chart itself. And, however, there's no indication that volume is reliably heavier on the down days, which would be a bearish signal. Thus, it's a neutral sign. It's neither bullish nor bearish. It just is. The momentum indicator below the yellow bar graph, it has just broken to the upside at a green 0.44, which is a bullish sign. And most importantly, the market forecast, which is on the bottom, the overbought and oversold indicator, is above 20, the green line, and it's pointed upward towards the upside, which is generally the most reliable bullish indicator. Thus, if Google can break the 20-day moving average and close above that mark, that would indicate the ceiling of resistance is broken, and that would be a good entry point if you were looking to buy this stock. On a final note, I would expect some heavy resistance around the 200-day moving average. Again, that's the red line. And I would not be surprised at all if Google would test the 50 and possibly even the 20-day averages again if it were to fail the test and fail to break through the 200-day. And when I say break through, I do not mean intraday. I mean having an actual close above the 200-day moving average. That would indicate the ceiling resistance broken. And if that is the case, I would expect a breakout and new 52-week highs to follow shortly thereafter. Thank you very much, guys. Please hit the subscribe button. Throw me a like, throw me a comment. Did you like this video? You want me to do some maybe more on my IRA positions and, kind of more forward-looking statements compared to, in the short term, because this is really a long-term position with Waymo. We're thinking the next 20, 30 years, guys. So thank you. Go vote. I appreciate all the support, guys. I'll see you next time.